Hello, you're watching BloombergQuint, and this week we're marking 10 years to the Lehman Brothers collapse and the global financial crisis triggered by that, as well as the events surrounding that. Useful then to look back at the lessons learned and head for the state of the economy and for warning signs. And to do that, I'm joined by a very special guest today, Paul Sheard. Now, he was global chief economist of Lehman Brothers, based in New York at the time of its bankruptcy. He later went on to become the former vice chairman of S&P Global, a ratings agency, and that gives Paul a very unique vantage point into what went on at the point of the crisis and the years and the events that folded thereafter. Paul, thank you very much for speaking to us here at BloombergQuint. I'm going to start with a less financial question and a slightly more emotive question. Your memories of that day when Lehman did announce its bankruptcy and what went on thereafter?
Well, the day itself, I guess you're referring to the Sunday, the 14th of September, the application for bankruptcy. I think it was the early hours of Monday, the 15th of September. But it was a funny kind of day, because I think I actually popped into the office in the morning and I came back in the afternoon. And it was a very different scene from the morning to the afternoon. Still quite quiet, not many people around in the morning in the office. By the afternoon, as you probably saw on the TV screens, many people in the office packing their things and moving. So at the very end, on that last day, so to speak, things really kind of turned dramatically on a dime as far as the employees were concerned, I think many of whom thought that by Monday morning we might be working for a different company rather than a company that had just applied for a Chapter 11 bankruptcy.
Did anything in your professional life, Paul, prepare you for that day or the events that took place thereafter?
Well, Menaka, it's funny you should say that, because I actually had a similar experience. I moved from academic life to Baring Asset Management in early 1995, and nothing to do with yours truly, but shortly after joining that firm, of course, the Great Barings event happened. As it happened in that case, a company came in and bought the company, and particularly the unit that I was working for, the asset management company. So, life went on. But in terms of waking up one morning and finding that your employer has failed, I actually have two experiences of that.
There's nothing about you that makes you an ordinary employee. These were not ordinary bankruptcies. So I'm still going to persist in asking you the question, how did you assess the events of the weeks after, especially in the Lehman case, the sense of crisis and panic that started off in New York City and spread across the world?
Well, I don't think, there are a few, people who, claim to, or perhaps they did forecast the financial crisis coming, but most people didn't really see the chaotic turn of events which happened and were triggered kind of by the Lehman bankruptcy. But let's not forget, just, about 8 days before the Lehman bankruptcy, the two GSEs, Fannie Mae and Freddie Mac, were put into conservatorship, essentially bankruptcy. And then, of course, we had a whole number of institutions that were being drawn into a kind of vortex, a downward spiral. So it was very difficult to sort of forecast that event, and then on the back of that, then to say, well, what impact will this have on the economy? But what we saw, Menaka, as you know, in the fourth quarter, and then extending into the first quarter of 2009, was the global economy, particularly the developed world economy, falling off a cliff. So the financial crisis rapidly transmitted into the real economy and caused falls in GDP of 4, 6, even 8% in Japan's case. So again, that was pretty difficult to forecast. But the key thing in the fourth quarter that one had to look for was really, what are the policy responses going to be and how effective will they be? And I guess I was a little bit better prepared for this again than some market commentators, because I lived through the Japanese experience. I spent most of the 1990s and up until 2006 based in Tokyo, following the Bank of Japan's efforts to reboot the economy and the whole banking crisis there. So my lessons that I took away from Japan were that if policymakers are faced with a major financial crisis, they have to act very quickly, they have to act very aggressively, and they have to act in a coordinated fashion across all the different margins of policy adjustment. And I think that's pretty much what we saw, particularly in the US, in the fourth quarter of 2008. So as a markets analyst, I continued to work as an economist, trying to figure out what comes next. That was what I was looking for, and that's what I saw. And so I was relatively comfortable that the economy in the US in particular would start to pick up again in 2009, and that did indeed happen.
Paul, I do want to remind our viewers that you've written an excellent column on BloombergQuint.com talking about what you thought the lessons were of this crisis. Now, the cause of the crisis, as you've explained it, and as have many other economists, especially in your column, as you've put it, is simply and briefly the gap between the real economy and the financial economy. But is it really ever as simple as that? And in your opinion, what characterized this crisis versus the others that we've seen, whether it's all the way back to the 1930s?
Well, I think there were a number of things, Menaka, and usually when there are big events like this, it's not just one variable that's driving it. There's a confluence of factors. One of them was, the Great Moderation, the fact that for several decades, again, the U.S. economy and some of the other major economies, Japan accepted, had a very tamed business cycle. People had sort of been lulled into a false sense of security. And one of the great economists that was really rediscovered with the financial crisis was Hyman Minsky, not really a household name before the financial crisis, but certainly since he has become famous from the grave. And he pointed out in the late 70s, the early 80s, that if you have a prolonged period of stability in the economy and moderation, that excesses will start to build up, complacency sets in, and then the whole thing will come crashing down. It's impossible to predict the timing on that, but he had the story right. The other thing is related to that, in the run-up to the financial crisis, you had this kind of market fundamentalism had taken over. Chairman Greenspan perhaps was one of the supporters of this point of view, but the idea that markets were essentially self-correcting and you didn't need a lot of regulation in financial markets. And I think we've definitely learnt that lesson, that you really need policymakers need to be focusing on the whole balance sheet of the financial sector, which is the quality of the assets and the valuation of the assets on the left-hand side of the balance sheet. Then on the right-hand side, there are two components. There's the debt deposits that financial institutions issue and their equity. And the lesson, I think, is that the deposits and the debt that financial institutions have issued, which is supposed to be safe, that can easily run when there is a lack of confidence, a loss of confidence. And one way to prevent that is to have sufficient equity on the balance sheet to give depositors and debt holders confidence that if there is some deterioration in the value of the assets, it doesn't mean that they're going to get hit. So really, it's the big lesson, I think, is to take a comprehensive look at the balance sheet of the financial sector from every particular dimension.
Paul, you've noted in the column and otherwise as well in our conversations, two lessons for policymakers. One, do everything possible to prevent a financial crisis, always easier said than done. And secondly, have at ready a well-crafted lender of last resort function and be prepared to deploy it quickly and forcefully. And then you go on to say that the second lesson has not necessarily been learned well, not then and not now. What do you think the implications of that have been in the last decade, and where that leaves us now or here on, if and when the next crisis strikes?
So again, I think very well summarized there that they're the two big lessons. Don't have a financial crisis. But if you do, and I think to a certain extent, just by the structure of the financial system and the economy, these things are perhaps inevitable at some point. There will always be the risk of a financial crisis. So you always want the fire brigade to be ready on hand. And particularly when you get into one of these financial crises, what happens is that the liquidity that you thought was there suddenly disappears, because ultimately the assets that are underlying the financial claims in the economy are fundamentally illiquid assets, the real economy, the infrastructure, all of the sort of institutional capital that's there. So at the end of the day, who is going to reliquify the system to sort of quell this, what can be an irrational stampede for the door, at the end of the day it really boils down to one actor, and that is the central bank as the lender of last resort. But I think when you look at a lot of the commentary and the policy response, Menaka, to the financial crisis, the first lesson was well learned, and there are a lot of efforts to make sure that a financial crisis doesn't happen again anytime soon. But on the second dimension, I think that lesson was not really learned in the right way. In fact, to a certain extent, the opposite lesson was learned. This idea that we must prevent too big to fail, and we must never put taxpayers' money at risk again. We must close down, as they did in the United States, the ability of the Treasury to inject capital into the banking system. The TARP, which was probably the most effective troubled asset relief program, which was the bank recapitalization program in the US, probably the killer app in the policy response to prevent a Great Depression. That whole program, which was controversial, was closed down in October 2010. And even some of the ability of the Federal Reserve to do some of the lender of last resort activities that it did have also been restricted. They're not completely gone, but they've been restricted. And I think that, I understand that the thinking there, nobody likes the idea of moral hazard and bailing out highly paid bankers. But nonetheless, it's one thing to try to prevent people from lighting fires, but it's another one to close down the fire brigade, so when there is a fire, there's nobody on hand to put it out.
I'm just trying to understand. You're talking about fires and nobody at hand to put them out here on. What does that mean? And I'm just going to cite some numbers to you, Paul, just to try and understand how you assess where the global economy stands today, right? So the Bank of International Settlement says that we are now standing at a total debt across all economies in the world at $237 trillion, and that's a full $70 trillion above pre-Lehman levels. America's public debt to GDP ratio stands at about 105%. That's substantially higher than the 65-odd% that it was at when we went into the Lehman crisis. And of course, with quantitative easing, central banks are sitting with about $15 trillion of assets. That's a record number on their balance sheet. So effectively, the question I'm asking you is, have we run out of all the ammo that we may have had to be able to deal with the crisis? Where do we stand today? Better or worse? Do we have anything left to deal with the next one?
It's a very good point you raised there, Menaka. What tends to happen in these circumstances is the debt sort of shifts around in the system. So in the run-up to the financial crisis, there was a lot of debt had built up on the household balance sheet in the US and on financial balance sheets. Not so much the sovereign balance sheets or even the corporate balance sheet. In the wake of the financial crisis, a lot of that debt, of course, has been written down or deleveraged, as they say. But it sort of popped up, particularly on the government balance sheet, the sovereign balance sheet. So I think there is definitely some concerns about what happens next. However, I'd be a little bit more I don't think all balance sheets are equal, let's put it that way. And just looking at total debt numbers perhaps is a little bit misleading, because the sovereign, of course, issues debt, but also has the ability via the printing press, if you like to call it, the central bank, to actually produce its own currency at will. Now, there are obviously reasons why you want to restrict that ability, but corporates, banks necessarily can't, just households can't print their own currency. So I'm less concerned about the sovereign debt situation per se, simply because sovereigns are in a different category. What I would be a little bit more worried about is that if there is a financial crisis, that you don't necessarily get the kind of policy responses that you might be able to get in theory, but in practice you don't get them because people have got preconceived ideas about what you can and cannot do. So again, if you think of the Eurozone crisis, the sovereign debt crisis, that was the second round of the crisis for Europe, and the Europeans kind of responded by going into fiscal consolidation mode, and that actually made things even worse and probably led to further debt piling up. So I think in a real crisis, it's only the sovereign that has the balance sheet and the ability to create liquidity, to print money, if you like. And if they don't use that, ability, there is a possibility then that the whole system comes crashing down.
We just heard from Christine Lagarde at the IMF, and she says that 10 years after the Lehman crisis, the world is safer, but not safe enough. Let me put this to you in very common people language. Are we better off today, Paul, than we were in 2008, 2009?
Well, again, we'll never know until we see what lies around the corner. But my judgment would be that we are definitely better off. If you went back to summer of 2006, and if you said, would you rather be in the world as it is today, or would you like to rather be in the world of summer 2006? I mean, I would choose today. We don't have, we've learned a lot. There have been a lot of lessons learned, and there are a lot of now, policy tools in place, macro-prudential tools, etc., that were not there before. And again, there has been a stress testing of the whole global financial system, and there has been a learning process taking place. People have learned. Now, again, it doesn't mean that in the future something could not happen. Yes, there are vulnerabilities in some emerging markets we've seen recently, and people do worry about debt levels in the developed world. Again, I worry about them perhaps less than other people. One thing I rail against a little bit is you will hear these debt numbers. Take Japan, for example, quoted in terms of debt to GDP ratios of something like 240%. But actually, if you look at Japan's net debt, it's much less. It's about 140%. But I don't like the percent idea. It sounds really on my conscience, more than 100%. But really, the unit in that case of debt to GDP levels is number of years of GDP. Essentially, it's asking the question, how many years of GDP would you need to fully pay off the sovereign's debt? And therefore Japan's case would be about 1.4 years. Now, governments have an infinite horizon. They have a very long life, and they don't really need to pay off their debt. So I think sometimes these numbers, Menaka, are thrown around in a rather sort of spectacular way that makes it sound a little bit scarier than it is. I do think that if the sovereigns have good political systems, good governance systems, good macroeconomic policy frameworks, and understand the nature of the risks and the policy tools that they have at their disposal, they can get through most financial crises. If they don't react in the right way, if they're operating under almost false assumptions about what they can and cannot do, and they're not able to respond, that's when you're going to get the worst and scariest kind of outcomes.
Paul, I have a final question, and that also is one of concern. I've raised the debt issue with you. Let me raise the asset price issue with you as well. When you look at equity markets and how they've fared ever since the global financial crisis or the Lehman collapse, we've seen the sustained bull run across many, many geographies, not just in the US or not just here in India. Would you say that asset prices in some ways, at least especially in equities, are out of sync with global economic growth? Or does any of this worry you or send up alarm signals?
I think it's definitely on the radar list that you would want to look at. Again, perhaps I don't want to sound too complacent, but I'm sort of less worried about that. I think there definitely could be some correction in equity markets, but I think there is some misunderstanding about this issue. We've had this dramatic, you mentioned the central bank's balance sheets before, Menaka, dramatic expansion of balance sheets, which of course to a large extent is really just the central bank taking the government debt off the government's balance sheet and putting it on its own balance sheet. So it's really a shift of consolidated government liabilities within the consolidated government. But that process is going on. But what is the mechanism by which this quantitative easing is supposed to influence the economy? Well, it does operate pretty much like all monetary policy through asset prices, and it was trying to push investors into more riskier assets, create positive wealth effects, etc. Now, when you tell that story, it sounds all very artificial and like a house of cards that might be about to come down. But of course, all of that was in service of getting the economy on a much better trajectory. And that's, to a large extent, what the equity market is also discounting. So yes, there might be a little bit of artificiality built into risk asset valuations, and as central banks withdraw their monetary stimulus, that will start to be corrected, but it will be corrected off a base which is fundamentally different. So, for example, real GDP in the US is something like 15% above its pre-crisis peak. In Italy, it's still about 5% below. So, I think you have to look at, when you look at the asset market valuations, what has happened in the real economy and what has happened to nominal variables as well, because real GDP is up 15% in the US, nominal GDP is up more like 25 or even more than that. So, again, could something go wrong? Yes. But I think we have a good test case, Menaka, which is the Fed has hiked interest rates 7 times now. It's started to unwind its balance sheet. And 2 or 3 years ago, many people, naysayers if you like, were saying the moment the Fed starts raising interest rates, they'll prick this bubble. Well, that didn't really happen.
All right, but like you said, we don't know what the future holds. Paul, appreciate you joining us here on BloombergQuint to talk us through what the last 10 years have been like. And here is a request to all our viewers. Do read Paul Sheard's column, a fabulous account of what he thinks the last 10 years have taught us. Paul Sheard, thank you very much for joining us here on BloombergQuint.
It's a pleasure, Menaka. Thank you.
Good news.